In 2025, combined employee and employer Canada Pension Plan or CPP contributions will be approximately $8,848. That is a lot of money for most Canadians. Whether this is good news or not is a question everyone should be asking. I'm Ben Felix, Portfolio Manager at PWL Capital, and I'm going to tell you whether CPP is a good deal for Canadians. I posted about CPP on Twitter a few weeks ago, and some people were infuriated that I would say anything positive about it. People don't like feeling like the government is controlling their savings, but the reality is that CPP is one of the most valuable retirement income assets for most Canadians. CPP is a social insurance plan designed to contribute to retirement incomes in Canada. It's not designed to be the only retirement asset, but it is designed to be one of the pillars in a retirement income plan. For many years, CPP was designed to replace 25% of income up to a maximum called the yearly maximum pensionable earnings, but by 2025, contributions will go toward future benefits with a replacement rate of 33.33% up to an increased maximum. This enhancement is funded by an increase in required CPP contributions, which began in 2019 and will be fully implemented by 2025. This is objectively good news, but people often think that they could do better investing CPP contributions on their own, that CPP won't be there for them in the future, or that their contributions will be wasted due to an early death. Each of these objections shows a lack of understanding of the benefits of CPP. The CPP benefit is an inflation-indexed annuity. That is the only truly risk-free asset for a long-term investor. Inflation-indexed annuities are not available for sale privately in Canada, which makes sense because they're extremely risky contracts for a private insurer to issue. This makes CPP extremely valuable. It's so valuable because CPP hedges three of the most important risks that retirees face: longevity risk, inflation risk, and sequence of returns risk. These are not risks that an individual investor can efficiently hedge on their own. Longevity risk is the risk of outliving your retirement assets. The longer you live, the more you need to be able to draw from your savings to fund your living expenses. Each additional year of life is an additional year of expenses. Empirically, the risk of depleting a portfolio of stocks and bonds before death increases with increasing expected lifespans, meaning that more individual savings are required for a longer life. But annuities address longevity risk in a different way. Rather than needing to save more to protect against longevity risk, pooling the longevity of many people together allows for the risk to be shared. When CPP contributors live longer than expected, they gain what are often referred to as mortality credits from the contributors whose lives ended earlier than expected. Hedging longevity risk is not something that any individual can accomplish on their own, but it is accomplished very efficiently in annuities like CPP. Inflation risk is the risk that the purchasing power of your assets is eroded by inflation. The biggest risk to retirees in historical data has been inflation. Risky assets like stocks and to a lesser extent bonds may provide sufficient returns to outpace inflation in the long run, but they do not tend to offer an inflation hedge. The implication is that while your investments may eventually outpace inflation, they will not necessarily increase in value when inflation is high, putting pressure on the ability of your assets to fund the rising cost of living. High inflation tends to have catastrophic effects on the long-term real returns of bonds and cash, the same assets that investors typically consider safe. The CPP benefit, on the other hand, offers true inflation indexing. Each year, the benefit for those receiving CPP is increased based on the CPI All Items Index. An interesting point on CPI indexing is that it may overstate actual increases in the cost of living by as much as 0.6% per year due to things like substitution. That is, people changing their spending habits in response to inflation. Like longevity risk, inflation risk is extremely difficult for any individual investor to hedge on their own. CPP, on the other hand, is in a much better position to deal with inflation risk. CPP contributions are increasing with wage growth, which has historically outpaced inflation by about 1% per year, and CPP Investments, the Crown Corporation that invests the funds held by CPP, is able to invest in long-term, often illiquid assets which would be unsuitable or unattainable for most individual investors. The so-called Canadian pension fund model employed by CPP Investments is quantifiably successful at hedging real long-term liabilities through thoughtful investment management. In addition to inflation risk, individual investors drawing down a portfolio of risky assets may be adversely affected by severe market declines or by high inflation and low real investment returns. Drawing large amounts from a portfolio of assets during periods of low returns can be challenging to recover from. Unlike a retiree, CPP Investments has an extremely long time horizon, and it has ongoing funding from contributions. It is in a much better position to deal with market volatility than individual investors are. The guaranteed income stream from the CPP benefit plays a role in reducing sequence of returns risk by providing a baseline level of income through all market conditions. Despite all of these benefits, people often seem to think that they will be able to do better investing on their own. But matching the benefits of CPP is not easy to do. It's important to understand that as a hedge asset, an asset that delivers a high rate of return under specific adverse scenarios like high inflation or a longer than expected life, it should not have a high expected return in normal conditions. And it's not a high-risk asset that could go to the moon. One way to assess the rate of return of CPP contributions is using the internal rate of return, or IRR, the rate of return that sets the present value of all contributions equal to the present value of all benefit payments. The IRR will depend heavily on the mortality and inflation assumptions used. In a simple example, with maximum contributions based on the full 2025 contribution rates and the expected maximum benefit being received in 2064, the real IRR, that is adjusted for inflation, at a normal life expectancy is a little more than 2%. Remember, that is adjusted for inflation. Assuming 2.5% inflation, we're talking about close to a 5% return on contributions. Yes, it is true you would have a higher expected return investing in stocks. PWL assumes an average nominal return of 7.08% for a globally diversified index ETF portfolio. But the whole point of CPP is that it will do well in scenarios where realized stock returns are lower than expected, inflation is higher than expected, or you live longer than planned. The other thing that doesn't get enough appreciation is that by providing a hedge against sequence of return and inflation risks, CPP allows investors to take more risk with their other financial assets than they could otherwise, increasing their overall expected returns. For this reason, comparing CPP to stocks makes little sense. At longer lifespans, the IRRs on CPP contributions increase significantly, particularly when the CPP benefit has been deferred, resulting in an increased benefit. This is particularly relevant for some demographics who have meaningfully longer life expectancies. Yes, if you pay into CPP for your working life and then die after one CPP benefit payment, you would have been better off with private savings. That is true. But if you live to be 100, you will benefit greatly. That's how mortality pooling works. It's not theft, it's insurance. I do understand that people don't like the government controlling their savings, but CPP is pretty great. The CPP benefit is the only inflation-indexed annuity available to most Canadians. It offers protection against some of the most significant risks that retirees face, and it does so in ways that individual investors are not able to accomplish on their own. This also makes planning to get the most out of CPP a valuable exercise, which is a topic I'll cover in a future video. Thanks for watching. I'm Ben Felix, Portfolio Manager at PWL Capital. If you want to learn more about how PWL incorporates CPP into retirement planning, you can book a meeting with us below.